The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone, and thanks for joining us today for our webinar. Today's webinar, Introduction to Group Health Captives. My name's Tom Schutz. I'm co-president of Group Services, and appreciate you all joining us today. I'm having a little trouble with my desktop. Sorry about that. Let me close this. There we go. Sorry about that. So welcome to our webinar. Today's webinar is part of a series that we've put together, Your Response to Healthcare Reform. And in that series, we hosted a seminar last week on ERISA compliance with Carolyn McNary from ERISA Edge. It's a very eye-opening session on the rules and regulations on ERISA, trying to comply with that, and the aggressive attitude that's been adopted by both the Department of Labor and the IRS in terms of audits and enforcing. And so I wanted to let you know that that presentation was available for download on our website if you have an interest. Of course, today's webinar is Introduction to Group Health Captives. We have Dave Conrad from Roundstone Group with us. On the 29th of August, we'll have a webinar on private exchanges, and on September 12th on claims data analytics, how to use your claims information to help you better manage both your group health plan costs as well as the health of your employees. And then also through our partnership and the Benefit Advisors Network, Stacy Barrow with the Proskauer Law Firm, internationally known law firm with Proskauer, we'll be doing a seminar on understanding self-funded concepts in light of healthcare reform, which that one and the claims data analytics fit very well with today's session. Our format for today is Dave has about a 30 to 35 minute presentation, and at the end of that presentation we will have a time for questions and answers. A little bit of housekeeping. Everyone is muted. It's just much easier. There's typically less interruptions in terms of being able to hear if everyone is muted. So if you notice it's generally on the right-hand side of your screen, there is an area for questions. And if you want to pose those questions to me either during the presentation or at the end, if I think it's something that might be pertinent to where Dave's at in the presentation, I'll bring that up to Dave. Otherwise, we'll have time at the end, sufficient time for questions and answers so that we can help you get the understanding that you want on group health captives. And then at the close, after the questions, I want to share with you opportunities for a feasibility study and some captive options that are in existence that we have available today. Also want to let you know that we will be recording this webinar, and we will send the link to the recording to you when it's available, and it will also be available for viewing on our website. So really, without further ado, I'd like to introduce to you today's presenter. Our presenter today is Dave Conrad. Dave is Vice President at Roundstone Group, a captive manager. I'm sure Dave will give you more background on that. They are based out of Cleveland, Ohio. Dave is also our captive director at the Benefit Advisors Network. Dave has been with Roundstone Group for almost 6 years, spends virtually every day of his life putting captives together, helping advise people on captives, and is very well versed in the captive world. Dave is a graduate of Ohio State University, a Buckeye at heart, with a degree in finance and international business, and also has his master's in international business from Baldwin Wallace College. So Dave, without any further delay, I'm going to turn the screen over to you, and we appreciate your taking the time to be with us today.
Okay. Thank you very much, Tom. I appreciate it. One question I have, Tom, is I'm still seeing slide 1. Is there a way to advance the slides, or is
yeah, actually, mine are mine are advancing.
Okay.
See if, Dave, I gave you control of the mouse. See if you can advance your own.
Okay. Yeah, is my internet down, or maybe we can ask other members, are they seeing that my presentation stuck on slide 1?
Yeah, if there's anybody in our office that's watching, could you let me know if your slides are advancing? Okay, they are not advancing. All right. Well, let me see if there's something that I've done.
Okay.
Sorry for the technical difficulties.
So they're starting to advance now.
Are they? Okay.
No, I'm on the last one now, I think. Webinar format, presentation, Q&A. Yeah, all right. One more, and then it should be up to me.
All right. All right. You should be good, Dave. You should be able to advance it.
Okay. I'm trying to, Tom.
All right. Here we go. Let me try this. Try that, Dave.
Okay. It's there, but page up. Okay, here we go, Tom.
Are you good?
You know what? I'll just have you, Tom. I'll say next slide, and you can advance it for me if that's okay. It's not working.
Okay.
All right. Well, good morning, everybody. I apologize for the technical delay. You'll never know that Tom and I actually practiced this, and it worked perfectly yesterday. So I apologize for that brief delay. But Roundstone Management is a captive manager, and we're also a managing general underwriter for this program. This is all we do, as Tom said. So Roundstone is a privately held company based out of Cleveland, Ohio. We're actually in Westlake, a suburb of Cleveland. And again, this is all we do. So I'd love to have any questions from you. We're experienced with looking at other programs out there, whether they be a multiple employer welfare arrangement, which this is not, some sort of SPAGRIA program, but all different connotations of this program we can discuss in this presentation or in future questions. So I welcome any feedback and any questions that you have how this works and how this might differ from other programs. So next slide. So this program is a captive program. And what a captive is an insurance company that's controlled by its owners. A group captive, which what we're talking about today, is we band together multiple employers, mid-market in size, anywhere from 50 lives up to 1,000 lives. We would band those employers together to spread the risk. But again, a group captive is a group of employers control the captive versus a single parent captive would be just one employer. The facility that we're using or contemplating using for your captive has already been built. We've been doing this program for more than 8.5 to 9 years, longer than anybody in the industry. And what we utilize is our rent-a-captive facility. So you're renting our capital and our surplus and our license and all those things. So we don't need to go out and build anything. This program was built 8.5 years ago, and all we're looking to do is the chassis, if you will, has been built. We're just taking groups of employers and sticking on the chassis and sending them off the assembly line, and the group's off and running. So we're not talking about today, hey, let's try to do one, and we'll look at doing a feasibility study. Group Services has the ability today to take one of the employers from the call and put them in a captive, or a bunch of employers and put them in another group captive. So whatever it is, it's ready today, and it has been for several years. Next slide. The types of captives are an agency captive, where like Group Services would own a captive. A single parent captive, where an employer on this phone might say, I want my own captive. I've got enough money. I want to fund this thing myself. You know, we've seen those, but what we're talking about today is a group captive, again, where we band together several employers, whether they have some homogeneity or they're heterogeneous, meaning the homogeneity could be you're all Group Services clients, or you're all in one SIC code, or you're all members of one network, or you could all participate in one health and wellness plan. So the homogeneity really can be just about anything. We've seen groups that buy paper clips together. Let's buy our health care together. We all come together once a year or twice a year for meetings. We're similar thought, so you get together. But it does not have to be your, all in the same SIC code or the same industry. Our heterogeneous captives have been just as successful as our homogeneous, whereby all the heterogeneous employers, so we have financial services, trucking, and nursing home, and all these disparate industries come together, and they come together for one reason. They have one really robust health and wellness plan administered by a group services or one of their vendors. So again, you have an agency captive where the agency would own it. You have a single parent captive where one employer would own it. But what we're talking about today is either a homogeneous group captive or a heterogeneous group captive for your health benefits. Next slide. The captives are a mainstream product. One of my favorite bullet points is that last one there where you see that the alternative risk transfer market makes up more than 40% of the commercial risk market. What does that mean? It means 40 cents of every dollar of insurance of businesses goes into this type of transaction. So if a dollar is being spent on work comp, property coverage, auto liability, auto physical damage, the P&C world, it's being dropped into one of these captives. All your Fortune 100, your Fortune 5, Fortune 1500, almost all of them have these captives. Okay, more than 5,000 worldwide. Now, there's actually when you see that number 5,000 worldwide, well, a lot of captives actually have rental facilities. So the one captive might have different cells in it. So there's actually more than 5,000. There's just 5,000 individual captives, some of which have multiple cells, kind of like they are exactly what we're talking about today, where Roundstone Insurance Limited has a captive, and your group of employers would rent one of our cells. So that 5,000 is misleading in the aspect that it's underestimated how many there are actually out there. The captive market continues to grow. If you pull up a Google a trend and you look at this, these captives continue to grow. Because at the end of the day, if you think that you can do a better job in controlling your risk, then you might as well control your profit. So if you truly believe that you're paying too much for your insurance coverage, or you want control over your insurance, or you want control over the data, or there's coverage that you just can't find, then a captive is most definitely the right product for you. The next slide. So now the rest of the presentation dives into the healthcare portion of it, and that's what we're on the phone today for. So what I want you to do is look at that very first bar, the $2,200 for a single and $5,800 roughly for a family coverage. This is a Kaiser study, and if you follow that bar chart all the way down, look at where we are today. Okay, more than double. And if you want me to update this for 2013, guess what? It went up again. But the good news, what everybody's celebrating this year, is it only went up 6.7%. So it's I don't want to say it's sad, but the health industry is celebrating that costs only went up 6.7% this year, okay, versus the 7, 8, 9 they've been going up previous years. So you can see that this is for the fully insured, it's been a runaway freight train. The costs just keep going up and up and up. And hopefully you as an employer are able to keep raising your prices and keep raising your revenue to match these expenses, because I believe healthcare is one of your largest expenses, and you can see the cost of it's doubled. And again, more than 100% over the last 10 years. Next slide. During that same time period, what's happened is a lot of employers have gone self-funded. Okay, during that same time period, a lot of employers have gone self-funded, and a lot of your larger employers have gone self-funded. So the employers above 400 and 500 have all gone, not all, about 80+% have gone self-funded. The reason being is, if you look at this slide, okay, what does this slide say? And I know the right-hand side is a little bit hard to read, but what the right-hand slide of it says is, if you're a 50 life group, you have an 18%. So 1 out of every 5 years, you have a chance of having a bad year in the self-insured world, okay? Now, if I'm a 1,000-life employer, okay, so I'm getting back to why large employers have all gone self-funded. If you're a 1,000-life employer, okay, the chances of you having a bad year are very unlikely. You know, once you get above 400, it's less than 2%. You smaller employers that are on the phone, well, you know, if you have 200 lives, you have about 1 in 7 chance of having a bad year. Well, what we're talking about today is group services is going to take a bunch of employers, so you could be 100 life, a 200 life, a 400 life, and combine you together so you're now a 1,000 life, a 2,000 life employer. So the chances of you all having a bad year are next to nothing. You know, the law of large numbers is kicking in. So that's what we're talking about today, is that we want to band together a bunch of smaller employers to get to what, so they don't have the chance of having that one bad year. Or even if you do have that one bad year, the profitability of all the other employers in your group is going to help extinguish some of that bad year that you have. Because self-insured, there's a large component of variable costs. So we do our best to predict what those might be for you once we see your claims data and your rates and your census and your plan design. We do a very good job of predicting what they might be, but again, what we're trying to do is reduce that volatility by combining a lot of you together. So again, the way to read that right chart, it was cut off a little bit, but a 50-life firm has a 18% probability of having a bad year. And again, a bad year means that instead of your expected cost being $1, they're $1.10. And again, we're trying to get a bunch of employers together so we're past that 400 plus mark to get to 1,000. Next slide. The reason a lot of employers do not self-fund, small employers, well, we said before, large employers all self-fund. The reason a lot of small guys do not do it, again, to be small is under 1,000 lives, is that first bullet point, volatility. What happens is the small employer is presented with a self-insured proposal, and you're on an island. So if you have that bad year, think about the previous slide. If you're a 200-life employer, okay, and 1 out of every 6 years, 7 years, you could have a bad year. You're by an island. You're by yourself, and you have that bad year. So the volatility scares you. What we're talking about is when we have 1,000, 2,000 lives, when you do have that one bad year, the underwriting profits come down and they help wipe out that volatility. The group is your shock absorber. You do not have to take a very, very large deductible and assume a lot of risk. I'm a 200-life employer. I can take a $50,000 deductible and let my group of 1,500 or 1,800 lives in my group absorb the volatility, absorb the risk. So you individually have a little bit of you do have some risk below your deductible, but above the deductible, the group of employers absorb the risk. And the second key is, why don't more mid-sized, smaller employers self-fund? You're not working with a group services that can look at you and say, here's a turnkey solution. Here's the TPA and the network we recommend. Here is the reinsurance we recommend. Here's the group captive. This thing's all set up. Here's the wellness. They literally have a turnkey program for you versus let's go out and build this and take our time and try to figure out all the components. They have a turnkey, simple solution for you. So again, some of the smaller employers, we know your HR staff isn't huge. There might be 1, 2, 3 of you at most at HR, or maybe a half at the smaller companies employee. So group services will work with you with a turnkey program and help show you how it all lines up together. The next slide. The difference between your fully insured world today, okay, and again, some of these bullet points slid off the page a little bit here, but the difference between the fully insured world and the self-insured world is, fully insured on the left side, the self-insured is on the right, is that in the fully insured world, everything is based off the cycle. And again, you think about cycle, that was that first slide. Well, it's really not a cycle. It's a straight-up arrow right now. Costs keep going up. So there's no smoothing of costs. It's transaction-driven, so meaning that your current consultant or broker shows up and says, here's the 3 offerings I have for you. That's it. Take it or leave it. in the self-insured world, there's a relationship. You get data. You understand the data. You then work with your vendors, your stop-loss carriers, your wellness vendors, and there's a relationship. It's not just whatever the program is. I got 3 pamphlets. I got to decide what it is today, and that's it. Everything's transparent. The data you have access to, and again, it's HIPAA-compliant data. You know what's driving your cost. Okay. One firm, it might be the pharmacy's out of control. Another firm, everyone's using the emergency room when they should be going to see their primary care physician. The other one, we have a bunch of diabetes, and we're doing nothing to control it. So once you have the data, then you can do something about it. If you don't have data, it's just a shot in the dark. Okay, it's a black box. You have no idea what's in there. But once you're self-insured, you have transparent communication. You have data. You know what to do. And you no longer have generic service. It's specialized and customized program to your needs. And the last bullet point is the most important. It says no return on investment. That's your fully insured world today. Think about it. Your consultant shows up, and what's the best they've done for you? Okay, the best that they can do to you is say, guys, we got a flat increase. They don't even like to say flat. They usually say flat increase, which means, hey, this is the year that your rates didn't go up. But generally they go up. You guys saw that previous slide, 6, 7, 8% every year. In our world, the group captive world, there's underwriting profits. So, the employers in our world, when their group does well, they're used to seeing money back. Okay, hey, my group did well, so guess what? Here's some money back. So instead of costs going up, they flatline their costs. My best group is a group of truckers. I like to share that story. And over the last 3 years, they've been averaging dividend checks of 35% of their stop-loss premium. So if they put $1 of premium into the captive, they got back a check for 35 cents, which is a great story. They're all engaged in wellness. But again, think about if you're in the fully insured world today, your broker shows up. The best you can do is beat them up to get them down to a 0% increase. Okay, next slide. Now, this slide, there's a lot going on here, but what I want to focus on is on the bottom left-hand side, you're going to see traditional versus captive. So, and the red line separates it. Imagine that's the curtain at odds there, okay? What we're suggesting, or what we're telling you in the slide, is that we're not changing traditional self-insurance, okay? For you that are fully insured on the phone, it's a little bit bigger step. For those of you that are self-insured today, we are not changing it. Every employer, A, B, C, D, and E, all get a policy from an A-plus rated carrier, size 15. What's that mean? It's a huge carrier, and it's A-plus rated. So it has the top financial rating. It's the biggest size you can get. You're going to get a policy from them. Each individual employer is going to get their own policy saying it covers all claims above X. So that could be $25,000, it could be $50,000, it could be $100,000. It's whatever your appetite for risk is. You're going to get a policy covering all the claims above that. Okay? So what we're doing is the captive, the group of employers. Now let's go behind the red curtain on the right. The group of employers is nothing more than a reinsurance facility. So what does that mean? That means this A-rated carrier is on the hook for everything, but we are, as employers, we band our hands together. We're the reinsurers to that A-rated carrier. The captive doesn't issue a policy. The captive doesn't do anything, funky or crazy. All we're doing is we're just like Zurich, Munich Re, Swiss Re, all these large reinsurance companies that these A-rated carriers have. We're just another one of those. We're just a reinsurer for this A-rated company, okay? And so when there's a claim above $25,000 or $50,000, whatever your deductible is, the A-rated carrier calls us and says, hey, we need the money, okay? So we're just a reinsurer for the A-rated carrier. But at the end of the day, the key to this whole slide is that bottom left-hand corner. It says you have a policy from an A-plus carrier. That's the key here. And behind it, there's this reinsurance facility again, which is all of us, okay? And we take care of the claim payments. The next slide. So what this slide, the how it works slide, demonstrates is that each one of you can come at different levels. This slide is pulled from an actual proposal. So when you do a feasibility study, you're going to see an identical looking slide, except they're going to have your numbers on it. So what this slide represents is this employer from 0 to 25,000 is taking on the risk themselves. So if there is a $100,000 claim, the employer is on the hook for the first 25, and then above 25, the captive takes care of it. Well, the dark blue box in the left-hand corner shows the employer's worst-case scenario. So this employer, if they have 150 employees, and all 150 employees and their families get sick and have organ transplants or some horrific claims, we've bought aggregate reinsurance. So where you see that arrow stops at $796,515, at the $516, they're out. They don't have to worry about it. So we bought, your insurance company has walls and ceilings, okay? So the wall around your individual insurance company, the one you're covering for your own employees, for your risk below your deductible, there's a wall for this employer. At the $516, they're out. They don't have to pay anymore. We bought an aggregate reinsurance policy. That's the wall. Their ceiling is $25,000 for the individual claim. So when there's a $100,000 claim, they only have to worry about the first 25, and then above that, the captive takes care of it. So again, the $796,515, that represents their worst case scenario. An underwriter will sit with you and say, here's what we expect your claims to be. However, if they come in well above expected, we're going to go ahead and put this wall around your insurance company and make sure they don't get any farther. So there's an expected, but this the term employer aggregate attachment point means your worst case scenario. Now above that, okay, you typically pay stop-loss premiums to stop-loss carriers, and they cover all the claims above $25,000 or $20,000 or whatever your deductible is. Same thing applies here, okay? So the money that you typically pay a stop-loss carrier, okay, in this case, you take the $198 plus the $107, let's say it adds up to roughly $305,000. That money you usually pay to the stop-loss carrier, it's a sunk cost, you never see it again, okay? That's the traditional stop-loss. Well, in the group captive, what's a little bit different is we're going to take about 65 cents of that $300,000 and drop it in this pool, okay? So that light, the medium blue color if you want, that is the group sharing. So that's where everybody on the phone is banding hands together and sharing risk. You have your individual risk, which is the dark blue, and then you have your group sharing of the risk, which is that lighter blue there, okay? So that is how much money your company is dropping into the pool. Now, your company A is dropping in $198, company B might drop in $500, company C might drop in $70,000. So we all drop in different amounts to the pool. Then we also have to pledge what's called collateral or reserves. All right. So you see that next color of blue in the right-hand corner. You cannot open or form an insurance company on premium alone. You need reserves. Okay. So we have to collect reserves from you, and we collect it with the first month's premium. And if you want to, when Tom sends you this presentation afterwards, if you want to write some notes on it, collateral or the skin in the game or the reserves, what is it actually going to be? If you're fully insured today, you're going to see that the reserve requirement's about 3% of your fully insured premium. So in other words, if you're paying $1 million today, you're going to see that the collateral requirement's around $30,000. So it's not a big number. If you're self-insured today, okay, the collateral requirement is going to be about 9.5% of your stop-loss premiums. So for those of you that are paying, $300,000 in stop-loss premiums, you're going to see that your collateral is around $27,000 or $30,000. So it's 9.5% of your stop-loss, 3% of your fully insured. So let's get back to this money. So there's a claim that hits this pool, all right? So you, the employer, have put money into the pool. Well, the pool absorbs the claim. It's a shock absorber. It pays. And then if I run out of all the funds with all the members of the pool, then I go to the collateral. So just so you know, that collateral, the years we've been running this program, we've never wiped out the collateral, touched the collateral. That collateral sits there. And, why is that? Or, well, we pride ourselves on good underwriting. But beyond that, go back in your head about 3 or 4 slides of that graph that shows the worst case scenario. think about it. Our pools are thousands of employers or employees. So when you get above that 400, what's the chance of ever needing reserves or hitting the worst case scenario? So, mathematically, what we're doing again is we do need to have the reserves. It is a requirement. However, the chances of hitting that collateral are very slim because your pool, the law of large numbers, kicks in. So what I'm saying is that collateral that you pledge, if history repeats itself like it has for hundreds of employers, you're going to have that just sit there and roll from year to year. If you ever leave, you get it back. It's not something that's a sunk cost or gone. But the last piece, it is your worst case scenario. So if every employer that you sign up with has a bad year and they all have transplants, millions and millions and millions of dollars, the worst case scenario to you you'd lose that collateral. That's it. So this is not an assessable. This is not a retro program, meaning if you leave or the employers all have a bad year, you'll never hear, at the door someone saying, hey, you owe us more money. Okay? There are programs out there like that. We don't design ours that way. If you look at the final, just as the individual employer had a ceiling and a wall to your little self-insured risk, the group has ceilings and walls, which are represented by the light blue bands around those boxes. So above $500,000, we've gone out and got reinsurance and to cover up to unlimited, and then aggregate. So we also have the group of employers is, again, there's aggregate reinsurance for all the employers. And again, that's why I can tell you on the phone today, I can tell you what your worst case scenario is if the 1,000-year plague hits the Midwest and all the employers have a bad year. I have reinsurance. So we wipe out the premium. We then go after the reserves. But beyond that, we have an aggregate wall. So this thing is contained. There are programs that fall short and do not get that aggregate reinsurance, and so they can't look you in the eye and say, here's your worst case scenario. Or they'll give you put an asterisk out there, we could ask for more reserves. Our programs are not like that. They are set up so you know your worst case scenario. Next slide, Tom. The 3-year captive trend is, it's coming up here. What this slide will show you is that the next slide is going to, can you access it, Tom?
Yeah, I'm having a little trouble here. I had this show up on my screen. I don't know how to get rid of it.
Okay. Maybe hit your next arrow on your screen.
Yeah. Sorry about that.
Okay.
This is what happens when you put me in charge of technology. There we go.
Well, they're going to put you in charge of benefits, so that's a good sign.
Probably won't happen for the next webinar.
So the 3-year captive trend, guys. So the 3-year captive trend, what this represents is if you think about one of the very first Kaiser slides that showed pricing, if you stayed fully insured, this is about where you are today compared to 2008. What the brownstone bullet points there represent is the average of all of our good, our bad, our ugly, of everything. This is not my best case scenario. My best case scenario I'd love to put on there because the line actually bends the opposite way. But this is of all of our employees, of all of ourselves. You can see that our employers didn't start paying more for their health care overall until 2012. So this works, okay? If you are engaged and want to get data on your health care and then do something about it, change your plan design, implement health and wellness, you can lower your costs, okay? Your claims most of your costs are driven by your claims, okay? And if you can drive down those claims costs through proactive, not reactive measures, you will see your claims, your cost of health care definitely drop. And again, this is the average performance of even, my good, my bad, my ugly, for everybody. All right. So the next slide, the impact of healthcare reform. So, if anything, the healthcare reform, the Affordable Care Act, which again some call it something else, but the Affordable Care Act has really been a boon for what we do, because before this time, everybody was just lumping along, and they took it on the chin. When their current consultant or broker talked to them, they absorbed a 6 or 7, 8, 9% increase every year. They just absorbed it. They realized they couldn't do a lot about it, Well, what's happening with the Affordable Care Act, what we're seeing is, and the folks in Massachusetts can tell you this, Tom's colleagues that work in Massachusetts can tell you the same thing. What happened when the Affordable Care Act was passed in Massachusetts? You know, what happened that following year? Well, what happened the following year is that, you know, rates went up, okay? And it wasn't because of your own doings, your individual employer doings. It was because we got to pay for the uninsured guys. And so, and there's got to be rate compressions and all these different items that you're basically going to be paying for the others. And if you stay fully insured, you know, there's more taxes, and you slip to the next slide, Tom. There's more costs. So the best way to manage this is jump out of the fully insured and go to self-insured, where you have more control. You know, you're calling the shots. There are a couple fees, okay, that are associated with the Affordable Care Act that do roll over to the self-insured, but it's nowhere near the amount of taxes and mandates and everything else that you have to absorb in the fully insured world. Okay, so like I said, the Affordable Care Act's been great for us because it's really given some employers a little bit of kick in the tail to say, you know what, I do need to go to self-insured. I do need to do what the largest corporations, you know, 1,000 or up, you know, 85, 90% of all these large corporations are doing. I got to do it now. Okay, before I didn't think I could. I didn't think I had the resources, but I can't take it anymore. Next year, when it's not my cause, when my rates go up because I'm insuring everybody else, I got to do something about it. So it has been truly a good thing for us. And so the captive solution to ACA, you'll see it as all the things that we covered a few slides ago. But again, this really is a great solution for those that want to take control. I will say that this is not a panacea, you know, this is not panacea for everybody. If you don't care about wellness, if you don't care about what's driving your claims costs, then I would say please stay fully insured. This is not for you. But those folks that are engaged in doing something about it, then this is a better solution. Slide 19. Types of employers. We've worked with, you know, all on this list plus some. I mean, religious organizations. I'm trying to think of a couple that are not on here. Attorneys. You know, you name it, this can work. All right, but it's not industry that's we're so worried about. It's the employer and the management. Are they engaged in group services recommendations? That's the key here. So the type of industry is irrelevant. Case study. So what I want to do is I want to kind of review. We had a meeting similar to what we're doing here today about 8 or 9 months ago with one of Tom's colleagues up in New Hampshire. And so next slide. So what we did was we talked to those folks and we said, we went over a very similar presentation, okay, had lunch, talked about it, and what happened was one of the employers that was in the room raised their hand to Tom's colleague and they said, hey Tom, I like this idea. So this employer went out and talked to 11 other of their colleagues in an association. Well, this association was nonprofit health and human services agencies spread across the state. Every single one was fully insured. They all utilized the Blues and other networks, so they're all over the map on where their current health care was. The designs, you know, some there was no, you know, employee didn't have to pay a cent. Some of the employees had to pay a lot. None of them really had much experience with wellness programs. And again, wellness, guys, is not running marathons. It's not, you know, 5% body fat. You know, but I tell you what, wellness is a lot more than the brochure that the Blues reps drops off at your office. Okay, wellness. There's some biometric testing where they find out where your health is today. You know, and hopefully in year 2, they not only test you, they test the spouse. Because if the family's healthy, then the kids and everybody gets healthy together. But it's you start where your employer is at today, or your employee is at today, and you build from there. The renewal dates were all over the place. You know, some renewed January 1st, some renewed July. The employers, these were mainly smaller sized employers, but recently we've had a 600 life and a 400 life actually request to join that we're going to bind into this group. So don't let the 200 lives fool you. You can do a lot larger organizations. But, you know, so what I wanted to show you on that slide is they came from everywhere, okay, and they're all different walks of life, and they're all fully insured. So they not only went self-insured, but they went self-insured via this captive. The next slide. So on April 1st, the group literally came together, and we set them up. They're all with one network now. They have a common renewal date of April 1st. And what we showed them is when we underwrote them, is that group as a whole is expected to save $3.2 million off of what they're paying today, not even off the renewal. So we didn't have to look at how much the renewals were going to go up, as they do every year. We just said, off what you're paying today, you're going to save $3.2 million, or the underwriter expects you to save that. I didn't even have to get to the second bullet point or even talk about it when the hands started going up and saying, we're in, we're in, we're in. What we do then is we say, you're expected to save this because you're being overcharged today. But more importantly, the group, the pooling, you're all worried about, hey, my large claims out, we expect the group to drop about another $500,000 back to you as members. So, and the biggest employer you can see is $600,000 of savings. But the next slide. But what I want to finish up on this is, guys, the benefits of this thing are, there is obviously the financial benefits, but when you work with like a group services, okay, they are an excellent quarterback because what they're going to do is you're no longer by yourself on an island. You're part of this group, this living, breathing group that group services can now share the data. And they can say, guys, this is working for one member of your group in the upper part of Iowa, and this is working for somebody down in Missouri that happens to be part of our group. And they can say, you've got the data, and now that we see what's going on at your firm, here's some suggestions, here's some metrics, and here's some forecasting. The wellness, this is how it's working. This is how they rolled it out, and it worked where they got 90% participation. So the additional benefits, I don't have a monetary number there because I know we all are impressed by numbers, and that's what drives us, and that's why a lot of us are for profits, obviously. But at the end of the day, I can't put a number to having one quarterback for the whole group, share the data, share the results, and help you with best practices across the group. That's what really keeps these groups together. These groups do not, you'll see once you're in these things, it's the best you can do. There's, the only thing you can do better than this is be a 2,000 life employer and have a $300,000, $400,000 deductible, and then have all these other benefits on there. But until you're that size, and you want to act like them and buy benefits like them, this is truly the best model that's out there. I think that's all I have, Tom.
All right,
Any
good.
questions?
Thanks, Dave. That's good. So why don't we open it up for questions? You've got the question box on the screen there if you want to type in your questions. And Dave, I already have a couple of questions that why don't we start with those, and then we'll monitor the other ones that come in. Dave, you talked a little bit about at the end there about I guess the power of numbers, and this question is really mostly about the structure of how the captive works and the type of captive. And so, does each member of the captive choose their own third-party administrator? Do they choose their own networks? Do they choose their own plan designs they want to use? How does their own wellness vendor, et cetera? How does that all work in the captive world?
So in the group captive world, you can either join an existing group captive. So if you think this is a good idea and it's something you'd like to pursue, you could say, you know what, group services, I'm not waiting for there to be some group thing. I want to do this, and then I will go out and engage others, but I want to do this. So you could sit down with group services and say, hey, can you give me a complete turnkey package? And so you could keep your own TPA, your own wellness, go lean on group service and say, give me a complete package that's customized to me. Or, like I said, on the group side, if you want to be part of a group, then sometimes these groups get together and say, we're going to have one wellness vendor, we're going to have one TPA, we're going to have one network. And what that gets them is they're now going to that network and third-party administrator saying, hey, there's 2,000 lives here. So we're no longer buying as a 100-life group. We're buying as a 2,000. So that lends me back to the case study. So in the case study, one of Tom's colleagues went to the third-party administrator, and he got them to lock in their rates for 5 years. Okay, so if a 40 life group walks into a TPA and says, "Give me a 5-year rate lock," they're going to laugh at them. So if you do go with one for the whole group, then obviously your fixed costs keep dropping and dropping and dropping and dropping. But you do not have to do that. You know, you can do a customized solution. So I hope that answers it again. You can either be flexible, or you can buy as a group and buy in bulk and just reduce those costs a little bit more.
Okay, that reminds me. I know for years I've had people, you know, at least say, "Gosh, you know, I think if I could just be part of a larger group, I would have better negotiating power." And I think you confirmed that that is one thing that you can develop through a captive.
Correct.
Okay, I've got another question here. It's, can you walk us through a renewal scenario where one particular group has a bad year? That's a very good question.
Okay. So how about we talk about my worst employer last year? So we had an employer last year in the mid. I'm in Ohio, so it's in the state where the Pittsburgh Steelers are. So next to us, and this employer had a horrific year. They had 3 large claims above their deductible. So the employer was actually nervous about getting kicked out of the group captive, although they've been engaged in health and wellness, but they were still nervous. So they went to their broker and they said, "Hey, go out and get us some competing quotes." So the broker went to the market, and 6 insurance carriers declined to quote because they've had these huge on-running claims, or one was ongoing and the other 2 were just one-time occurrences. But one market, Highmark, which is like a Blues in Pittsburgh, said, we'll take your business for a 40% fully insured increase. Okay. The renewal came back with us, with our group captive. They were my worst of all the employers, everybody I had. They got a 24% rate increase to their stop loss premiums. Again, that's a lot, and Tom, you can explain that in more detail, but to get a 24% stop loss increase is nothing compared to a 40% fully insured increase. But I say that now, after that, they're part of a group that got 20% dividends. So their net increase was about 5 or 6%. Okay? So my worst case performer, the one that had a large claims, a difficult year, went up 5 or 6%. So what we do is each renewal, we're going to look at the group as a whole, okay? But we obviously do look at each individual employer, and they get their stop loss rates adjusted upon their performance, but then it's weighted, you know, then you have this group think, or the group ability to knock some of that down. So it's typical renewal cycle for those of you who are self-insured, but the good news is you're part of this this group, and that group was doing well. The group would have done a lot better without this one employer in there, but everyone has their bad year, and that's the key here. So during your bad year, it's not as bad in these group captives. And during your good years, it's even better because the money that you were just sent off as a fixed cost, a portion of that comes back to you now. So that's the key element here.
Okay. Dave, that leads me to just a couple of other questions relative to that, and I think implicit in your comments is that in the captive, while they're part of the captive, from an underwriting and a renewal perspective, each group is still viewed individually in terms of what would happen at renewal. Is that correct?
Correct.
Okay. And then my second question, for those of you on the call who are self-funded, who have been self-funded, I think one of the big fears that everybody has with a large claim is this whole issue of lasering. And what do you see relative to lasering in the captive world?
Okay, so we handle lasers in a couple different ways. On the way in, you could say, hey, I'm forming a group, or I want to be part of a group that has no laser option. So you can do that, and you just be charged more stop loss premium. So you'd have to, again, for a no laser option, you could have that, you pay more. The second piece is very rarely, we've never had a group do that because they see the cost of it, and they say, well, let's deal with lasers when we get them. what happens is with the laser, our underwriter generally will give you 3 options. They'll say, here's what the laser costs, here's what the laser, we quota share between you and the group, because now again, if the group decides, hey, we want to share this across everybody, like $1 or $2 per employee per month, that lowers the cost of the laser. So what happens is, because you're talking to the underwriter, Roundstone is the underwriter on this, okay? We're a managing general underwriter. So the employer, and you have Tom, or group, any employee from group services, their underwriter, we get on the phone and we figure it out. So we generally give you at least 2 to 3 options of how to deal with the lasers. Nobody has ever left our groups, or even ourselves at all, because of a laser issue. We all get it. And here's the other key part is, you now, again, it's your data. A lot of these things you see coming, you know how to deal with them. You know, we had a laser last year, a potential laser, it didn't end up being a laser, where it was this simple. The employee was going to DaVita, which is a privately held dialysis consortium, and they were going there, and that was about 28 grand a month. And if they went to a private dialysis provider, we got the cost down to 6 grand a month. So it was a simple plan design change where we made DaVita out of network, and the private, and the quality of care is the same. We're not talking about reducing anybody's quality here. It was that simple of a change, reduced their cost $22,000 a month. So it's that, because now they have access to data. That's the key. So things like that, you know, we work hard on, okay? You can also do, if you want to do something, if you're worried about transplants, okay, you can buy transplant coverage for the whole group, or the individual employer can buy it. And that's something we can talk about too. I mean, that's a whole other conversation, but that type of coverage is out there also.
But your point is, if when you have data, you can find solutions.
Yes, you got it.
Yeah. Okay. And then a follow-up question on your worst group, it was, what happened to their claims funding factors on that group? I think you maybe touched on that, but...
You know, so what, you know, I think this person is, the individual asked the question, knowledgeable about, so there's an aggregate, what's called an aggregate attachment point. So that if you think about 10 slides ago where that's 796, 515, so yes, their aggregate attachment point there did increase before where the reinsurance kicked in, their aggregate reinsurance. I don't have that number offhand, but you know, definitely their aggregate attachment point went up. But again, didn't go up tremendously because 2 of those 3 claims were you know, just freak occurrences, if you will. And the other one was kind of an ongoing. So the aggregate attachment point didn't go up tremendously. And again, at the end of the day, the group stayed in. They didn't go to the full. And the other stop-loss carriers didn't quote on it. So it shows you that you know, this solution was the best that is, you know, was available to this group.
Mm-hmm. Okay. Okay. Good. Well, I think we've got time for one more question, so we can honor everybody's time. We promised an hour. Can you talk a little bit about reporting? What reporting is available? And I'm thinking about it in 2 different ways, Dave.
Okay.
Can you talk about what kind of captive reporting do you do as far as the performance of the captive? And then also the second is reporting relative to claims and data analytics, claims data analytics as well. What do you provide, and what comes from whoever the consultant might be? Okay,
so I'll answer the first question, and I'll put the second one back on to you, Tom, because you're the consultant in that world, so you'll take care of that. But the first piece, what Roundstone Management does is every quarter you're going to, 45 days after the quarter, so let's say you're a 1/1, your quarter ends March 31st, so on May 15th, 45 days after the end of the quarter, you're going to get an income statement type balance sheet document. It's basically, we call it an experience statement. It's going to tell you, employer A, how you're doing, and then the group as a total that you're part of is doing. So you're going to know not only how am I doing, my insurance company, they're in my insurance company, but the insurance company that I'm part of as a whole is doing, okay? So there's no surprises. And then we've got like reports that's going to show, we rip out the names of the employers obviously and all that, but we're going to say here's the, here's some of the claims that are running hot. This is where, they're above 50% of their spec. So you're going to get a quarterly analysis, so there's no surprises here. Every quarter, okay? And then after the year's up, we do a final draw. We draw a line in the sand, and 6 months after the underwriting year's over. So if you're a 1-1, on June 30th is when we distribute the dividends, or the underwriting profits, if you will, for that year. So every quarter you know how it's going throughout the year, and then on June 30th you get your profitability checks. So that's how it works from our, because we're running your insurance company. In terms of data and that, I mean, you're going to work with group services, right, Tom? You're going to sit down and build reports, whatever they want,
Right. So the claims, that's, I guess I want to make that distinction. You're going to report on how the captive is performing financially.
Correct.
So the claims data analytics is going to be a function of two things: either what reporting the TPA that you choose, or that serves in the captive, if there's only one, what reporting that they will provide, and or the consultant that you use, if they have any claims data analytics software that is available to really take that TPA information and dig in deeper, and to be able to slice and dice and peel away the different layers of the claims onion to do that. And so that's more where the claims side is going to go, and how you evaluate whether or not your wellness plan is performing, and those types of things. So that works out well. Dave, we're out of time. I've got a couple things that I want to follow up with or close on, but one of the questions we might want to follow up on, we'll see if there have questions, or I may ask you to respond in writing, has to do with how does the underwriting profit get distributed? So I'll follow up with you on that. I just want to let everybody know that we're going to do that. So let's talk about what are your next steps. And thanks, Dave. That was a great presentation. As I promised at the beginning, a couple of things I want to talk about. What are available captive options that we have today? Because it's not a theory. There, we actually have options, and talk about a feasibility study. So captive options, we really have a couple of different things going on. I'm going to use Dave's terms. Hopefully I pronounce it correctly. But in the homogeneous captive, we have an employer that is looking to form their own captive. And they have some very specific requirements for anyone that might want to look at the captive. They want it to be everyone to have a consumer-driven plan design, a high deductible with the health savings account, that consumer-driven model. There's a specific wellness program and vendor that we're already using and have had some success with. And again, we're a contribution strategy that's tied to wellness participation. What this particular employer that is working to put this together is they subscribed to Dave's comments on being able to take the group and use the strength of the size of the group and the negotiating power to drive down some of those fixed costs by having everyone use the same vendor. And so that's available. We're working to find other employers that might be interested in that concept and learning more about that. We also have in the heterogeneous captive market, or my term of art, and I heard Dave use it in the past as well, as a rent-a-captive, basically. So they exist. You can move into that captive, be part of it. And Dave didn't mention that, but one of the things you can do is move into these captives. And if down the road you want to separate and to get into your own captive or form your own, you can do that. But the three that we have available, there are two that we've got through the Benefit Advisors Network. And you see them on there. One's what we call Wellness Light, Wellness Heavy. Wellness Light meaning there's some wellness. It's mostly a communication type. It might be for someone who doesn't feel like in their organization they're ready to make a full commitment to integrating wellness and participation in wellness in their plan design. The wellness heavy is just the opposite. It does integrate that, and it would be for someone who is interested in heavily integrating wellness and is interested in managing the health of their employees and managing their costs in that way. And through Roundstone, and this has really the longer history, they have the mid-market med captive that they've got, and they have two branches of that, if you will. One where all the groups renew January 1, and one where all the groups renew July 1. So if you'd like more information on those, let us know. And then as Dave also talked about, and we talked about at the beginning, one of the offers that we have is a feasibility study. So if you're looking at this and saying, well, I'm kind of interested in this, it seems like I should know more about it, and we've seen a lot of interest, of course, as Dave said, with healthcare reform, we can work with Dave and with Roundstone and do a feasibility study, which is basically pulling your information together and showing you what it would look like in a captive, probably one of the rent-a-captives. The type of information that's needed is it's really the kind of stuff that you typically pull together, and we can talk about in more detail if you're interested, but census, claims history, that type of information, cost history, premium history if you're insured. We've got a simple forms and checklist, and what you get back is what would be technically what would look like a proposal for the captive. So you could see how the cost structure looked. You could find out, ask more questions that would be specific to your organization. So in essence, what you'd get is you'd be informed, and you could determine from there, hey, is this a strategy that we should be thinking about more seriously, or is it not? So it allows you to think about that in a little more detail. So just wanted to let you know those are available. I want to remind you of our webinar series. I hope you can attend those. They fit together very well. The claims data analytics is a really good match to the group health captives, and we have some tools that are available that we're going to share with you that I think you'll find that you'll see how important that claims data analytics is to managing your cost. And then we've got our benefit advisors network as well that fits in. So Dave, let me thank you so much for taking time from your busy schedule. You're always flying all around the country helping people with captives, and it's been a great presentation. And for those of you that have joined us, we appreciate you taking the time from your busy schedules. You have our contact information on the screen. We'd love to sit down and talk with you about the captive concept, members of our team. You can call us, you can email us. We'd love to hear from you. If you have additional questions, feel free to follow up with those questions. Thanks again, and our webinar ends at this time. Thanks so much.
Thank you.